You are listening to Keystone Stock Talk Show, episode 246.
If this is your first time listening, then thanks for stopping by. This podcast is produced every week for your enjoyment, and show notes are found at www.keystocks.com. Come back often, and feel free to add the podcast to your favorite RSS feed or on iTunes. You can also follow us on Twitter at Keystocks and on Facebook, and keep submitting your stocks via the usual social channels or at our website, keystocks.com, for our Your Stock Our Take segment. And we just might review your stock in an upcoming show and let you know if it is a buy, sell, or hold.
It's great to be back again this week. We kick off the show with a look at last week's poll, and I hit the viewer mailbag to answer a question on Colabor Group Inc., symbol GCL on the TSX, a distributor of food and related food products into the food service, institutional, and retail channels within Quebec. The viewer asks if this potential turnaround story has value. Aaron answers a viewer question on AltaGas, symbol ALA on the TSX, a North American infrastructure company that connects customers and markets to reliable sources of energy. Aaron lets you know if AltaGas, which pays a 4.1% dividend, is an energy infrastructure business you should own. Brett answers multiple viewer questions on Super Microcomputer, symbol SMCI on the NASDAQ, a provider of application-optimized high-performance servers and storage solutions. The stock is up 283% year to date and 965% over the past year. Brett lets you know if the gains are justifiable and can continue. And last but not least, in the media section of the show, Brennan answers a viewer question on Maple Leaf Foods, symbol MFI on the TSX, which produces packaged food products globally, including prepared meats, ready-to-cook meals, ready-to-serve meals, snack kits, fresh pork and poultry, and plant-based products. The viewer notes the stock seems to always be in the penalty box and asks if it can ever get out. All right, let's get to the show. We welcome my co-host, Mr. Aaron Dunn, and the Killer Bees, Brett and Brennan. How are you guys doing?
Welcome.
Doing
So
well.
this is the last podcast before spring officially starts.
Yeah.
It's
It
on
sure
the
feels
What's the day this year? What is spring? Do you know the day? 21st.
Never heard of her.
21st, yeah. So imagine we won't be doing a podcast next week because we'll be in LA at the Roth conference.
We will. We leave on Sunday, so it'll be difficult to record that one. So we'll have a full update on what went on at that event. But there's 400 plus companies. They do 5,000 interviews. We'll be doing 20 to 25 in that range. There's 3,500 participants. It should be a busy but good event, and we look forward to interviewing some good, solid companies there, and then potentially from those interviews, making a couple recommendations to our clients going forward. There'll be some companies there that are also in coverage that we'll sit down with, and it'll be good to sit down with those management teams and get updates on those companies. All right, did you guys want to look at the poll question from last week? Brett, you got the poll.
Yeah, we can go through the poll from last week. So I asked, which of the following stock market sectors do you believe is the most undervalued? There's 11 of them, but I can only unfortunately list 5 in YouTube polls if you're wondering why there's only 5 of them. Mm-hmm. But so at the highest of what our viewers thought was undervalued was energy at 45%, healthcare at 23%, real estate at 15%, financials at 13%, and technology at 4%, as well as a comment from our favorite viewer, Shadow Jedi 007, mentioned minerals, mining and minerals, which is grouped in with other stuff as well, but that is generally a sector as well.
So this is just, did the question specify Canadian or US markets?
No, I did. No specification.
Okay. Yeah. I answered real estate myself, and a lot of people might be surprised to hear real estate and undervalued in the same sentence. But when you look at a lot of the REITs in the current interest rate environment, a lot of them are trading at big discounts, like apartment REITs, industrial REITs, pretty hefty discounts to net asset value, discounts to where the valuation's been over most of the last decade in terms of price to cash flow. So that's really where I'm seeing better value. Healthcare, our healthcare sector in Canada is almost non-existent. It's quite, interestingly, it's actually mostly, or was mostly, the cannabis stocks, although that sector has come down so much. I'm sure it accounts for less of the sector. But at one point, I mean, it was about 90% of our healthcare sector. There's a couple long-term care companies in there as well, but really, really not a lot. Energy, energy, it just depends on what the price of oil is going to be in the future, oil and natural gas. And without having that crystal ball, it's difficult to say whether it's undervalued or not.
I will say energy does look, at least when you're looking at individual companies, they don't have as much debt on their balance sheet anymore as compared to a few years ago, which is really nice. And the valuations have stayed a bit lower, because similar to what they were before, even with the debt. So that is really a upwards trend. But then, of course, we're seeing it around WTI around $80 for the last few months. Mm-hmm. Last year and the year before, we were seeing it at 100 plus, and we haven't really seen that same degree of oil pricing, and we're seeing it not really trend up at this point. So if you really want to look into the energy financing market, you're not seeing the same strength either that you were a few years ago, but then you're seeing lower debt. So it's a bit of a trade-off.
Mm-hmm.
Yeah, I wonder if we would have added gold, or if gold is a segment there, if people would have clicked on that segment, as the price of gold has moved forward, and the actual, particularly in the junior sector, like raising capital in that sector has been non-existent over the past year. So there are, some of the juniors, even the producers, haven't really participated significantly in the jump up in the price of gold to record highs. So I do wonder if people would have split their kind of commodities bet between oil and gas and gold and other commodities. So we won't know. Maybe we'll ask them what they think about gold next week.
I will also explain why. These are just the GICS sectors, where there's 11 of them. So
and there's not just a gold sector. Yeah.
Which would that be material? So that's your mining, all that sort of stuff, and everything. And then out, besides the ones I listed, you have consumer discretionary, consumer staples, information technology, communication services, which utilities. I did actually list information technology. I just call it technology though. But there's 11 sectors, GICS, if you want to look it up.
Awesome. Now, I think that Aaron's pick there for real estate segues well into a little topic we're going to hit on. Brett, you brought this up a week or so ago on the Canadian pension fund investment into some poor investments, actually, that they made. Looks like poor investments over the past several years. Do you want to detail that for a second for us?
Yeah. So the Canadian pension plan, they sold Manhattan Tower. They had a 29% stake in it for a whopping $1. And you might be confused. Why $1? Well, it's because they also offload the debt at the same time. And this isn't the first sort of institutional level commercial real estate deal that you'll see in the headlines, where it's $1 or whatever token amount just to strip their equity so they don't have to have the debt anymore either. And you're seeing that quite a bit in commercial real estate.
Yeah, it's these kind of the downtown properties. Following the pandemic, many office workers have been reticent to return to the office, and it's been tough for that segment of the market, and you definitely have seen a lack of demand there, and it's hurt Aaron, you've looked, and we've looked generally at the office REITs versus, say, for example, just residential. And the price differential on a price to FFO basis is quite a contrast right now. It's a stark contrast between what you're paying in the market for the two.
Yeah, there's good value in a lot of apartment REITs, but office REITs trading at a big discount to the residential space or to the industrial space. It's really the apartments and the industrial. That's where the attention has been, the positive attention. Office, shopping malls, those things, they're really kind of seen as declining assets. So, just as an example, Dream Office, one of the bigger office REITs in Canada, they just recently cut their distribution by 50%. That's not what you want to see from a REIT. You want a good, stable, consistent, sustainable distribution. So it's but I've not been very positive on the office REITs for several years. I'd say even before the pandemic. they just didn't have the fundamentals that I saw in the apartment REITs. I mean, of course, apartments, you're not gonna you you need a place to live no matter what, how the economy's doing, no matter what the trends are with work from home. Like you need a place to live, and that's where office really kind of stands out as a defensive essential asset class. Or sorry, apartments stand out as an essential asset class.
Yeah, like, and just reading like a comment here from like the actual article here on BNN Bloomberg. So they're just saying, the pension fund isn't actively backing away from offices, but it's not looking to increase its office holdings either, according to a person with knowledge of its strategy. Let me just see here. It said that someone declined to comment on the recent deals, but said that the fund has continued to invest in office buildings, including a recently completed 37-story tower in Vancouver. So it's tough to kind of read into it. I mean, obviously, the sector, the space for office REITs has been hurting. But again, this is just kind of an article. We're seeing them themselves, but who really knows the strategy behind the Canadian Pension Plan and Investment Board?
I mean, I think it's probably just that they're not looking at completely exiting all office positions. But I mean, these were development projects largely, so there's a lot of liability that goes along with them. And they reconfigure what their projections are, and it's not a space that they really want to expand on.
Yeah.
And outside the sector a bit, you'll see in U.S. regional banking, the ones that were heavily in commercial real estate, so your office real estate, they're actually taking loan loss provisions. So they're getting really prepped up to expect losses on some of their outstanding loans to these office buildings, which is another aspect. You saw that last week with NYCB. They fell intraday to like $1.70, which is about a half price just overnight, and then it shot right back up as they were able to gain funding. So you're seeing the commercial real estate actually affect the financial sector as well, not just within the commercial real estate. Yep. And you saw that last year as well with the couple of banks that went under.
Mm-hmm. Yeah.
Yeah, so, and as a side note to that, like regulatory approvals, we're following a bank that's trying to it's Canadian based, trying to get access to the U.S. And typically the process would have taken maybe 3 to 6 months, and it's taken a year because U.S. regulatory situation has slowed ground to a halt, really. And now it's just starting to move forward, and we likely will see that approval go through in the next quarter. But, it's been delayed a year, where maybe that, it's probably taken double the time that it should have taken. But that's just an aside to some of the things that went on around this time last year in the U.S. financial markets. And, people are looking at the commercial real estate sector in the U.S. As a potential area of concern for the course of this year. So we'll definitely monitor that.
Yeah. If I could also just say, I know Ryan's going to make fun of me because no one cares about the Saskatchewan housing market.
We knew that was coming. So
of course, no, it's a little bit of a segue, but I thought it was pretty interesting, and I brought it up to the guys that Saskatchewan ended up implementing this secondary suite incentive grant program where essentially they'll provide, like the Saskatchewan government will provide 35% of the total price to construct a new secondary suite at an owner's primary residence to a maximum of 35 grand. So I thought that was kind of interesting. Like the housing market has still been pretty hot in Saskatchewan, as hot as markets get out here. But it is going to be interesting to see how many people take advantage of it. I might even take advantage of it if I ever end up buying a house. But they're just trying to put in these other incentives of people trying to put basement suites in their places because there is such a lack of supply. So I thought it was interesting.
I don't want to put you on the spot, but do you know if it's just if you're living in the place, or if you're a landlord, do you still get the grant as well? Or
you need
I don't
to
want
be,
to put you on the spot.
No. And all I know that it needs to be your primary residence.
Yeah.
So you actually have to be living there. So I don't think that, anyone who's, a landlord, unless again, it's someone in their own basement suite. And, and they go into, what a qualifying secondary suite is, where it actually has to have a separate dwelling unit and entrance, but yada, yada. Like there's more, of course, but
keep telling us more. I'm just kidding.
I think we need to move on.
Yeah, you think?
But anyways, I just thought that it was an interesting, thing that they're bringing forward.
All
We'll
right.
see what happens.
Good. Our Saskatoon update. We've got it again. Awesome. Thank you.
You
All
love
right.
it.
Well, we've got
Be a
we do.
special segment of the show every week.
Yeah, it's critical. We should move on to the questions, as we've got a big report to finish this week for our U.S. clients, and we've got 20 companies to go through to get prepped for the interviews to start early next week. So let's move through the show. I'm going to start off. So I'm going to do Colabor Group. Its symbol is GCL on the TSX. Trades about $1.19, $121 million market cap. So it's certainly a small cap in the Canadian market. They are a broadline distributor of food and related products into food service, institutional, and retail channels within Quebec. Colabor is a wholesaler to smaller distributors in the province. Let's look at their historical revenues and gross profit. Well, you can see revenues dropped over the past 10 years from about 1.4 billion in 2014 to about 659.1 million in 2023. We have seen an increase since 2020, so that is kind of the turnaround situation happening, which is good to see. Gross profit, as the business has shifted, has actually improved significantly from about 30 million over the same period up to 119 million this past year. EPS, this is the last 5 years in the trailing 12 months. It's been a little spotty in terms of where they've been. 7 cents about 5 years ago, about 6 cents over the quarter this year. There was a low of around 4 cents during the pandemic. So let's look at recent quarterly and year-end numbers, Q4 and 2023 annual numbers. So solid growth in terms of revenue for the year was around 15%. However, the quarter was a bit of a slowdown. It shows 1.6% quarterly growth. The 2022 period included one more week. So if you factor that out, it was about 5.8% growth on a like-to-like basis. Adjusted EBITDA improved. But again, the margin, although the margin did improve, it is only 5.9%. Operating cash flow, as we see there, it's good. It was up 50%. Let's take a quick look at the balance sheet. We're looking at net debt to adjusted EBITDA. We're less lease liability payments, for the last 4 quarters. It's at about 2.4, up from 2.3 in the same period at the end of last year. We would not like to see this ratio increase significantly, given the fact that the company has a relatively low margin profile. Let's look at the valuations. EV to EBITDA about 7.4 times. Forward-looking ratio 6.8, and the PE right now on a trailing basis is about 23.8. In terms of EV to EBITDA multiple, the company is trading slightly below its 5-year average, but not so significantly that, given the fact that it is a lower margin business, that we would make it close to a buy in our coverage right now, particularly given the leverage on the balance sheet. So I'm going to conclude this. The company just completed a new facility, which is something we are interested in. This is a new wholesale and distribution facility. Completed it in late 2023. This past year, it was about a $15 million CapEx project. The estimates are it can increase capacity about 2 times in terms of revenue over the long term for this company. It is intriguing if organic growth via the new business the new facility can ramp up into the new facility, but the current valuations, the low margin business, and the leverage make GCL just fair value at present. All right, that's going to conclude it for me.
Yeah, so Colabor, it's been around for a while. I think it used to be an income trust way back in the day, and then it was a dividend payer for a while, and it went through a restructuring.
Yeah.
Way back, the balance sheet leverage was much higher. It's good to see they've got it down to about 2.4 times. I agree with you. That's fully leveraged, though. It's not, I'd like to see the leverage a little bit lower, but it's not horrible, but there's not a lot of space to add more debt on there and keep a strong financial position. But it's a very low margin business. I mean, you
Yeah.
look just net profit margin.
Just distribution, food services,
Yes,
whatever. If it's
very low
just
margin,
distribution,
right?
you're making low margins. Yeah. Yeah.
Yeah. I'll be going into
5.7
that too.
million earnings, I think, for the year off
Yeah.
of 650 million in revenue. So
Yeah.
less than 1%. So like that's really low. I'd like to, it's interesting that they think they can double their revenue capacity.
Mhm.
But what is
So
what happens with
that
the
is something
margin
that
then,
interests
right?
us, obviously.
Yeah, because if like obviously having a lot of revenue is not their problem. Their problem is driving it to the bottom line. So how does the expansion really do that? Would be
Yeah, and is that all coming in organically, or do you have to buy that business
Mhm.
and jam it into your facility essentially? If you're able to organically grow the business into that facility, then potentially you pay down debt with the cash flow, and then you can get to a point where a low margin business might have some interest to us with some good organic growth. But if you have to go out and leverage further to buy other businesses to take their business, bring it into your facility to start bringing up to the capacity up to where you could be, then you're just again getting more into debt. Or if you create cash flow, you're just using that cash flow to buy more business, and the debt still stays on the books. And these businesses don't typically get a high multiple in the market. So when it's trading at 6, 7, 8 times, um, I've seen distribution businesses trade at 2.5 times, right? So you can trade at extremely low valuations, and in our opinion, a 7, 8 times on this isn't a extremely low valuation.
No.
And on an earnings basis, it's still 23 times, which is above the market PE. So,
Mhm.
it's for us, it'd have to be a significantly low PE, a path towards kind of paying off that debt and producing some cash, and then a path towards organic growth upticking. And, I don't think they've proved that out yet. The turnaround does seem to be positive. But if you look at where their share price was 10 years ago, you'll see it has not been executed well over the long term. All right, let's move on to our next company. Aaron's going to look at AltaGas ALA on the TSX.
Okay, excellent. So yes, we're going to take a look at AltaGas. So this is a company that I've actually answered a few questions on for clients over the past year or so. It has a history which we're going to get into, but anyways, AltaGas it's a utility, regulated natural gas utility, and also midstream processing company. A symbol is ALA on the Toronto Stock Exchange, trading at about $29 right now, $8.6 billion market cap, and it pays a yield of 4.1%. So at its core, it is a natural gas infrastructure company. There's two sides to the business. About 55% of the business is utilities. So this is regulated gas distribution, primarily in the United States. 45% is midstream, primarily in Western Canada. So these are assets like gas gathering and processing, natural gas extraction, transportation, and storage. So if you look at the company's performance over the last year here, pretty impressive. It has a nice 12-month chart. Longer term, a lot of volatility in this company. And we can see if we go back to 2014, 2015, the stock was trading at about over $50 per share. Had a really rough time for several years after that, and then just more recently, it's been recovering. So there's some history here which we can talk about in a couple of slides, but let's take a look at the current financial situation of the company. They recently put out their Q4 financial results. Good results overall. Adjusted EBITDA up 10.6%, normalized net income up 13%, and then normalized earnings per share 75 cents, up almost 12%. Now, for the full year, results were really more or less flat. Adjusted EBITDA up about 2.4%, net income down 1.5%, as were normalized EPS of $1.89, which was down 1.6%. So looking at the guidance for 2024, looking forward, the company is expecting to increase its normalized earnings per share by about 10%, getting to about 205 to 225 per share in earnings. adjusted EBITDA growth in the range of 11%. They have $1.2 billion planned for investing capital over the year. And they also are doing a 6% dividend increase. So that was just announced recently in March. Longer term, they want to continue to deleverage their balance sheet. They're targeting about 4.5 times net debt to EBITDA. And they're looking at long-term annual dividend growth in the range of 5% to 7% per year. So when we break this down across its business, one of the things that we often look at with utilities is whether or not the revenues and the EBITDA are contracted or regulated, or whether or not there's exposure to commodity prices and volumes. So in the case of AltaGas, we can see for 2024, they're expecting about 54% based on take or pay or fee for service contracts. So this is essentially stable, recurring revenue, highly visible, supports a sustainable dividend, and about 46% is based on commodity prices or volumes or differentials in commodity prices. Long term, they want to increase their take or pay and fee for service revenue and EBITDA up to about 70%. So really, this is the higher quality cash flow for the business, and we can see that 54 to 46%. That really reflects the breakdown of the company. With respect to utilities or midstream, it was about 55-45 utilities midstream. So basically that take or pay comes down to the utilities, and then the more fluctuative EBITDA is attributable to the midstream business. Taking a look at the balance sheet, one of the things that's really important to analyze when you're looking at a utility company is the balance sheet, making sure that it's not over leveraged, because this is a capital intensive business. So all of these companies have a significant amount of debt. In the case of AltaGas, a total debt of about $8.5 billion, equity of $7.7 billion. So I would say that the balance sheet right now is fairly reasonable. Debt to EBITDA of about 5.4 times, and the debt to equity of 1.1 times. But I talked a little bit about the history that this company has had and how in the past it was trading at over $50. It went through years of just horrible performance for its investors. And really what this was attributed to was an over-leveraged balance sheet due to the company overextending themselves on acquisitions. So they made a couple of big acquisitions. They're very acquisitive in that 2016 to 2017 period. And the debt to EBITDA got up to about 7.2 times in 2018. So that really took a toll on the company. A few of the assets didn't perform as well as expected. Share price went down, and they really had to do a big deleveraging over the next couple of years. Now, the way they were able to achieve this is they had to sell some of their higher quality assets. They had a very nice a run-of-river hydro asset in British Columbia, northern British Columbia, that they had to sell, that had only been commissioned about a year or two before. There's a few other things, but they were able to get the balance sheet leverage down, which was something they really needed to do. And now, again, they're targeting about 4.5 times, which we would consider to be a very reasonable debt leverage ratio for a utility company. Then in terms of financial performance, the company's been doing fairly well for growing their normalized earnings per share over the last several years. So really good growth from 2018 to 2021. A bit of a slowdown in 2022, but still pretty positive. And then 2023, the year that we just finished here, we saw actually a slight decline. So now they're looking at about 10% growth going into the next year. They had mentioned their long-term target, 5 to 7% earnings per share growth on an annual basis, dividend growth on an annual basis. So we would want to see earnings per share growth reflect that. If they're going to be able to grow their dividend sustainably at 5 to 7% without overextending their payout ratio, then their earnings per share need to grow at least that rate as well. So it does seem that it has generally been growing more or less at that rate or higher, and is expected to do so in 2024, just with the exception of last year. But with a lot of these companies, that's just the way that it works. It's going to ebb and flow, the growth. There's going to be some quarters where it's a little bit higher, a little bit lower, but generally speaking, the track record is looking good on that for the past 6 years. Now, in terms of our take on AltaGas, well, the fundamentals have been improving. We've seen some growth in earnings per share, a significant deleveraging of the balance sheet. But more than half of its EBITDA is contracted. Payout ratio is good. I didn't get too much in the payout ratio, but it's about 56% of earnings per share for 2024. That includes the recent dividend increase. So We think the payout ratio is conservative, and then they're targeting that consistent dividend growth in the range of 5 to 7% per year. On the opposite side, growth did flatten, so that's something to pay attention to. They did come slightly below the mid-range of their guidance for 2023. So let's see how they do in 2024. They do have the history of overextending themselves with acquisitions. Now, this is in the past. I think that they've learned some lessons there. It's a new management team, so that probably doesn't really have much of an impact on how we feel about them going forward. Deleveraging, that great deleveraging that we saw was, again, largely achieved by selling some high quality assets. Again, this is something in their past. I don't think it necessarily affects them that much in the future. So our take on AltaGas, overall, we think that it has good fundamentals as utility stock. What we think investors should anticipate from a company like this, just as a general guide, would be a total return in the range of about 10% per year on average. So that's about a 4% yield, that 5 to 7% dividend growth consistently over time. You're getting up to about a 10% total return. So for somebody who has that expectation, we think that the company is well positioned.
Yeah, it's a good way to set the expectations for a company like that. Some people have expectations that are too high, but if that is your expectation for that company, that could be a justifiable position within your portfolio. Typically, we're looking for a little bit more growth than that, but it is a reasonable return in that range. So let's move. Do you guys have anything on Alta?
No, all good.
We're good. All right, let's move on. I think Brett, and you're going to. What are you doing this week?
Super microcomputer, symbol SMCI on the NASDAQ. It's a provider of application optimized high performance server and storage solutions. The company develops and builds server solutions at scale with its building block solutions system, I should say. The company is trading at $1,085 per share at this time, and it has a market cap of $61 billion. There's quite a bit of volatility in stock, so if you're looking at this tomorrow and that price is off by $100, blame the volatility, not me, because the stock is trading up 283% year to date, and that's 965% over the past year. Massive gains over the past year if you're holding it over the past year. But diving into the last quarter, fiscal Q2 2024, which is just year-end 2023, net sales increased 103% to $3.66 billion from $1.8 billion. Gross profit increased to $564 million from $337 million, a 67% increase. Gross margins, however, fell to 15.4% from 18.7%. So the company is not seeing that gross margin uplift like a semiconductor manufacturer like NVIDIA is doing. Unlike NVIDIA or really any other company that has seen this massive uptick in sales, plus the increased margins, it's really a multiplicative effect. You're seeing the opposite with Supermicro Computer. You're seeing the bottom line shrink in regard to sales when you're looking at compared to like the sales growth, I should say. So it's not as big of an increase when you're looking at a decreasing margin compared to an increasing margin because it is that multiplicative effect. The company attributes the decrease in gross margin to product and customer mix, partially offset by lower cost of goods sold and manufacturing efficiency. In the conference call, the company elaborates on this, saying it was really to win over new customers and remain competitive. In other words, they need to compete on price to acquire additional sales. So they're taking a lower margin to get that sales number up, which is why you're seeing higher sales, lower margin. Well, part of the reason that they likely would have had higher sales regardless, I should say. Supermicro really needs to compete on price, though, as the product being really server racks and server systems is not really a product unique to them. There are many other manufacturers that are combining the subsystems, your CPU, your GPU, your storage systems to create server racks and servers. It's not unique to them. That's why you get these lower margins compared to the NVIDIAs or the Intels or the AMDs of the world. It's not them actually manufacturing the individual components. But continuing to move down the income statement, the company has increased its operating costs, SG&A, R&D by 58% to $193 million. As sales and gross profit increased at a high rate, this implies some sort of economies of scale at least. The result is operating income of $371 million from $250 million, a 73% increase. Moving down to net income now, it increased by 68% to $296 million from $176 million. Net margin came in at 8.1% compared to 9.8%. So the economies of scale is less impactful than that decrease in gross margin when you're looking at the sales relative basis. On a diluted per share, the company's EPS was $5.10 compared to $3.14. Then on a non-GAAP EPS basis, it was $5.59 compared to $3.43, with the only significant adjustment in their non-GAAP being really share compensation. They had some litigation stuff in the prior year, but really it's just share compensation for the adjustment. Shifting to the balance sheet, it's strong, net cash position of $350 million, so no concerns there. For fiscal Q3 2024, the company is guiding to sales of $3.7 billion to $4.1 billion and a GAAP EPS of $4.79 to $5.64, a midpoint of $5.22, which would imply sequential, so quarter-over-quarter improvement of about 2.3%. So still growth, but you're not seeing that massive uptick of growth like you did over the last quarter. For the fiscal year, the company has upped its previous guidance, however. It was previously $10 billion to $11 billion. And now it is $14.3 billion to $14.7 billion, a 38% increase from the midpoints. I will say, however, they did completely exceed their previous guidance, whether they not do that again. But you're seeing that across really the entire industry. You're seeing pretty much anything to do with semiconductors beat their guidance. I think they're really sandbagging their guidance in many cases just so they can beat it, or it's them not expecting it, which is management not having the foresight to see what the actual growth is to be. So that's actually can be a bit of negative because they're not seeing the foresight. So once it falls off, their guidance may be way overshooting it as well. Moving to valuation, SMCI trades at a whopping trailing P of 85 times, a price to sale of 6.6 times. These are not cheap. We can look at the historical average P, which is about 19.5 times, and that's even accounting for the recent couple quarters of high price to earnings, which does push up a few points. Like if you're looking in reality, it's probably closer to 15 prior to this. You can see as well on that graph that there was actually a period which it was trading quite a bit below that average. And that's really when you saw the earnings uptick before the massive price increase. And that's when you would have actually wanted to buy. But that's different now. Because even on a forward basis for the yearly guidance, the price to sales is still 4.2 times. If you take the PE and the net income margin at 9%, which was actually above the last quarter, so being optimistic here, that's still PE of 47 times. That's still very high. You need a couple more years of these super high growth rates to support the current valuation, the current 1085 share price, $1,100-ish share price going forward. You need that high growth to even support the current share price, let alone any more further appreciation. So concluding, Supermicro's computer share price has just surfed the AI wave, but the company's performance, all by benefiting from AI, does not support this degree of increase. When you're seeing a tenfold in price year over year, you need to see massive, massive numbers of systematic change to the company's operations. You're not really seeing that here. You're seeing them still build the same products that they were really 5 years ago. Of course, new technology, don't get me wrong, but it's still the same server racks. You're not really changing much when AI, instead of a GPU, you're putting an AI accelerator, which most of them still call it GPU anyways, your NVIDIA H100 cards, whatever you want to call them, some sort of AI accelerator, but their product is really the same. They have not really changed anything, which is why you're not seeing this margin increase like you are in other sectors, in the other semiconductor space. So, and as well, they're to increase their sales, they're actually seeing a decrease in gross margin, meaning you're unlikely to really see that huge expansion in net income margin like you have in other companies as well, which really limits the growth of earnings. Yes, the share price should have increased year over year, but it is way too much at this time. You're way ahead of yourself. You're really priced to, I would even say, over perfection at this point, which is the concern. Yes, the company's operations may do good, but they're pricing in so much growth at the current price that is just too high at this time.
Yeah. Tremendous growth probably this year and into next year. Hardware, any type of hardware business priced at those valuations historically scares me because you just, in hardware, there's booms and busts, and also it is a race to commoditize any type of hardware over time. So, they just don't get the multiples that like a software company could consistently get over time. Aaron, any thoughts? Brennan?
No,
You
it's
got
it's
nothing.
it's an expensive valuation, right? I mean,
Yeah.
if you're willing to pay, 85 times or even 47 times forward, it's there's other companies, higher margin business, more recurring revenue style businesses that you can buy if you're willing to pay those valuations. So for me, I mean, obviously there's a lot baked into that, a lot of expectation baked into that. It's so far above where, the valuation has been in the past. Of course, we always have to consider, I mean, is, a lot of times companies change, the outlooks, the markets completely change, and it justifies a higher valuation. But yeah, I mean, it's too expensive.
All right. Well, let's get into the meat of the show. Brennan, you've got Maple Leaf Foods, right?
I sure
The
do.
meat of the show.
You've been waiting all day for that one, haven't you?
That's all I got. So I got
Of course, he has. So yeah, this question came in through YouTube. And I was a little bitter about this because me and Brett had a laugh about it. But he says, "Hi, hey Brennan," in brackets, Killer B number 2. That's what I'm a little bitter about. I think that I'm Killer B number 1. But Ryan says Brett and Brennan. Brennan and Brett doesn't roll off the tongue. Brett, Brennan, it rolls off the tongue. So I get it. But anyways,
and that's why. That's the only reason why I say his name first.
Exactly.
Right?
Number 1 right here.
B
Number
squared.
1. Yeah. So anyways, he says, "I'd appreciate getting your thoughts on Maple Leaf Foods. It always seems to get in the penalty box regarding stock performance. Always appreciate your analysis." Well, I'm glad that you always appreciate my analysis. So hopefully you appreciate this one. So looking here, Maple Leaf Foods Inc., MFI on the TSX, currently trading at a price of around $23.10, a $2.8 billion market cap, and a dividend yield of about 3.8%. So the company produces packaged food products globally, including prepared meats, ready to cook and ready to serve meals, snack kits, fresh pork and poultry, and plant protein products. So since 2018, the stock really hasn't done too much. The last time we covered Maple Leaf on the podcast was as a dog of the week in August of 2022, after the stock was down around 17% after releasing week Q2 2022 results. And Aaron, who did the segment at that time, noted that analyst estimates for 2023, so the year that they just reported, were approximately $1.10 adjusted earnings per share. But as Aaron stressed on the podcast, we should take this estimate from analysts very, very cautiously. So looking at the financial results here, revenue in Q4 of 2023 was up around 0.6%, so basically flat, but to $1.19 billion. And this was primarily driven by the company's meat protein group sales, which were up 0.8%. Adjusted EBITDA was up over 100% to $120.2 million, with the adjusted EBITDA margin increasing to 10.4% in Q4 from just 4.7% in Q4 of 2022. And adjusted EPS was 8 cents per share, up from a loss of 28 cents in Q4 of 2022. And note that in 2022, analysts, were anticipating adjusted EPS of over $1 in fiscal year of 2023. Well, that was pretty far off, given the company only did 9 cents adjusted per share in the year. So right now, Maple Leaf currently has net debt of about $1.75 billion and a trailing net debt to EBITDA multiple of 4.1 times. And for context, the company's debt is primarily variable rate, with a weighted average interest rate of 8.2% as of December 31st of 2023. But about 20% of the floating rate debt has been fixed at 4.7%. With an interest rate swap. So that is something to note. And management also noted in their press release and on the conference call that they are now currently focused on deleveraging. So quickly looking at the valuations, the stock trades at over 200 times trailing adjusted earnings, with an EV to EBITDA of approximately 11 times and a price to cash flow multiple of approximately 16 times. Now, looking at the company's 2024 guidance, management anticipates low to mid-single-digit revenue growth and is looking for adjusted EBITDA margin expansion over 2023, and this is supposed to be led by the normalization of the meat protein group's adjusted EBITDA margins to 14 to 16%, where they did, again, about 10% in fiscal year 2023. And they believe that this will be kind of led by the pork market, which has had some difficulties here recently. So the company has grown the dividend quite aggressively over the years, from about 4 cents per quarter in 2011, and it's now up to 22 cents per quarter in 2024. Now, the dividend currently does not look sustainable given the company's depressed profitability. However, I'm not going to declare that the dividend will be cut, as in fact, the business just increased the last dividend by 4.8%. But we really need the company to get back into meaningful earnings before we have confidence, as even if we annualize the Q4 adjusted EPS of 8 cents, we are still left with a forward payout of about 275%. And again, that is looking, or just using the Q4 adjusted EPS, and we're annualizing it. So, really, we would really like to see profitability improve in 2024 and for the dividend to become more sustainable. I give enough companies a hard time when they issue shares like it's their day job. So here you can see Maple Leaf share count has actually been quite steady and declining since 2016, which is a good thing to see. So I will give them props there. Now, moving on. So to conclude, at this point, Maple Leaf is really a turnaround story, in my opinion. They're coming off of a difficult post-pandemic period by a dislocated pork market, inflation, disrupted supply chains, and consumers increasingly under stress. And management is looking for, the pork market to normalize in 2024. But this is very difficult to predict. I saw, an article from an organization out of Alberta. They were saying that, the outlook is actually not that great for 2024. Again, it's a commodity. It's tough to tell. But margins are beginning to essentially recover, and management does expect this to continue with restored health of supply chain, as well as, increased pricing to catch up to inflation. And like I previously said, management is focused on paying down debt and to be more disciplined on CapEx spending in 2024. So it might be a little bit of a cleanup year we see here. So Aaron mentioned back in 2022 that the company was finishing its London poultry and bacon center, which management believes will further be accretive to adjusted EBITDA in 2024. And long term, Maple Leaf has grown its revenue with a compound annual growth rate of about 5% from 2014 to 2023, and it's guiding for similar growth in 2024. The company currently trades at, like I said, 16 times cash flow and 12 times EBITDA, and pays out a nice yield, although a very high payout ratio at this point. And the leverage is quite elevated at over 4 times net debt to EBITDA. So, overall, I think that Maple Leaf is a good company, and someone could invest with maybe a contrarian approach if they believe the company is in fact on the other side of its headwinds, which will allow it to increase its profitability. However, at this point, I think it's really a show me story of replicating the margins in Q4 of 2023, further paying down its debt, which, is kind of above our comfortable range, and getting the payout ratio in a reasonable bound by, again, increasing those margins. So that's really what we're trying to see here going into 2024, is to see those margins continue to hopefully increase, which management is, expecting right now.
Yeah, I'd say there's nothing worse than a dislocated pork market, is there? That's one of the things that I dread when I think of what could go on in a year, have a dislocated pork market. No, but Maple Leaf's food seems to be continually... Pardon? Keeps me up at night. It does. If anything does, it's that. Maple Leaf Foods, to me, seems to be continually a next year story. Every time I look at it, analysts expect a huge jump in profitability in the coming year. But then that doesn't materialize, and the growth story is pushed out for another year. I like the products, but I think Brennan said, so show me the story. So show me the money. Show me the profitability at this point. Yeah. And bring down that debt a little, and then it could get interesting.
So Brennan's declaring that the dividend will be cut?
No.
Yep, he declared it. I heard him. He said it.
Exactly.
I did not say that.
Quote,
they just increased
Brennan.
it. So. I can't see that they'll.
No, but I think
cut.
I mean I don't know if they're basing the payout ratio on adjusted earnings or where, but like obviously when you're looking at a payout ratio, any payout ratio that's above 100%, you've got to start to be wonder where the sustainability is, right? I
Exactly.
mean, either they're basing it off of free cash flow and free cash flow is better, or they're just looking at growing into that high payout ratio. But it's you can't say that a dividend's sustainable when you're paying out more than you're
Exactly.
producing.
And I caught the tail end. They're buying back shares. They have over the last 10 years.
Yeah, I mean,
they've reduced the share count, right?
Yep, they've been reducing.
So, but
the share count, correct.
they have a significant debt position. So,
Yeah.
Yeah. So, I mean, it's where you're allocating capital. It's nice to reduce the share count, but the debt levels are high right now. So,
Yeah.
And high interest rate, 8.2%, and
it's
something
shrinking
that,
cash flow. Obviously,
I brought up the interest rate swap. Well, I mean, it would be good to see when that actually comes off. When is the, I think it's about 18% of their debts, fixed with that swap. When's that going to come off? So, that'd be another thing that I'd have to look. And I should have done for the listeners, but I didn't. I apologize. Don't hate me.
You do it for clients, though, wouldn't you? That's what you're saying, right?
Yes.
Yeah. Awesome. Okay, well, we keep your questions. Again, you guys got nothing else, right? You're looking forward to, we're going to California. We're going to California next week to interview about 20, 25 companies. I should come back with a potential couple recommendations or at least some updates from existing companies in coverage for our clients. But if you're just listening to the show, keep those questions coming in for our Your Stock, Our Take segments, or any question you have about the markets, your portfolio, and we'll answer them. And you can win. That's why I'm holding this up. It's you'll get mugged by Keystone. We'll give you a mug for the best question every month. All right. Well, I think that's going to end off our show for this week. Again, if you are viewing this right now, smash the subscribe button on YouTube. If you're listening on YouTube or on where is it? Where do they listen?
Apple, Spotify.
I'm sick this week, for God's sakes. I can't remember. Yeah, Apple, wherever you consume your podcasts, rate and review us on iTunes, and only positive reviews. That's what we always say. And as always, I'd like to wish you profitable investing. Thank you.
Great. Thank you.
Thanks, everyone.
Thank you.